Also keep in mind what the markets have done so far, rather than only worry about what we've seen in the last 1 week or 10 days. The markets are about up 33 odd percent last 1 year. For the year to date, we've already up 5%. Plus, we've seen so much of news flow and positive news flow that a lot of sort of trading money has also been invested in the market. I think that is what possibly explains some profit booking after the budget, wherein the news flow is out, after the RBI rate cut. So a little bit of profit booking is what is playing out. And that is also coinciding with the data that we saw from the US, wherein the housing data was so strong and the jobless data was so strong that there are expectations that Fed may actually hike in June rather than the earlier expectations of June to September quarter. So I think all put together, maybe that's shaking a little bit of quick money or fast money which had come out. But on a longer term perspective, as you said, most of the positives are in place. I think we could see data flow through in the next 2 to 3 years, which would point towards economic recovery and earnings flowing through. So I think in the extreme short term, I agree with you. We've seen a little bit of markets giving up their gains, but I think everything is intact with a 2 to 3 year view.
If I look at the history of all bull markets, typically when bull markets they start, valuations are always expensive and earnings always come with a lag effect. So should we really worry about earnings? Because the chorus on the street is, where are the earnings, where are the earnings, where are the earnings?
So yes and no. In the short term, yes. In the medium term, definitely not.
What is short term? What is medium term?
So next couple of quarters.
That is short term.
That is the short term.
Okay.
Next couple of quarters could be worrying in terms of expectations. I still think you'll have earnings recovery playing out. Economic recovery will play out, but versus expectations. So market is also about surprises versus expectations. So expectations were running high that the recovery will happen immediately and faster. That's where the disappointment can come in. But medium term, what you're saying is right. There will be a periods of earnings surprises happen. In our view, that's more likely to play out in FY 17 and 18 rather than FY 16, both from a top-down GDP growth perspective as well as bottom-up earnings perspective.
Are you getting a sense that this year could be a bumper year for Indian markets in terms of flows? Because on an average, we've got about $15 to $17 billion. And we've got $15 to $17 billion when macros were not on our side, when earning visibility was not there, and the stable regime was not in place. Now, macros are on our side, oil prices have come down, and we have a stable regime.
I think this year and the next 2 years, I think India would clearly show up in terms of FII flows as well as FDI flows. So this year, I guess we've already seen FII flows being positive for the year that we've seen so far. What the FIs would want to see even more is a little bit more reforms from the government, a little bit more action in the parliament wherein key bills get passed through. As we see progress on each of these fronts, I think FIs would get even more excited about India.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.